Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a global macro asset hedge fund manager, also an ex-venture capitalist and former investment banker. He founded and built several multi-million-dollar businesses in the investment arena, including overseeing the deployment of over $30 million into venture capital opportunities and advising family offices internationally. Prior to this, Chris MacIntosh built a career at Invesco Asset Management, Lehman Brothers, JP Morgan, and Robert Flemings. You can find his research over on the Capitalist Exploits website that features a number of paid investment research newsletters. Chris MacIntosh, thank you for joining me again.
It's a pleasure to be back, mate.
So, Chris, there's a lot of crazy things going on right now with governments and central banks, but what do you think are some of the biggest risks right now to the global economy?
Yeah, no, you're not far on. There's a lot of risks. What's the biggest risk right now? I'm not sure there's a number. So let's kind of tick them off the list, if we will. From an investment perspective, of course, inflation is a huge risk. It's far more significant, I think, than most people realize. The other risk is the dollar blowing up the world markets, currency markets, and bond markets, which it looks potentially like it's doing now as the Fed raises rates, and consequently Europe basically can't because they're too bureaucratic, and the debts are not centralized. There isn't a centralized bond market in Europe, and it means that their decision making is hampered by this sort of structural bureaucracy, and as a consequence, they're out of step. And so that we're seeing this fueling a dollar rise amongst many other things. That has a significant risk of emerging market balance of payments crises, like we saw in Sri Lanka. What else? Energy. I like to think of energy as a currency. Energy is the new currency. And actually underpinning everything, energy is the economy. You don't have an economy if you don't have energy. And of course, energy is under attack by the eco-mentalists. And so that's impacting now significantly Europe's a couple of months away from winter. And they have a significant issue there, not just massive energy prices, but really now looking at a situation where it's not just even price paid, it's availability of energy, and on the back of that, the second and third order consequences of a shortage of supply of energy is a shortage in food. So what's the one that's the most prevalent? I'm not sure, and they all are. The economy isn't it's not one thing. It's an ecosystem of many things, all of which interrelate with one another and create a dynamic of feedbacks. So, if you think about, we talked about energy, the cost of energy, natural gas in particular, has meant that your availability of ammonia has been hampered, and you can't make fertilizer without ammonia. So the lack of fertilizer means that a lack of productivity in the food chain, which means there's a lack of food. So you there's all these second and third order consequences that come out of one thing, and a lot of those. I think the main thing that we've been focused on at our hedge fund and in the publication service has been, this understanding that no matter what the Fed, or not just the Fed, the ECB, the BOE, the Bank of Japan, any of the central banks, no matter what they do with respect to monetary policy, they can't print energy, they can't print food, they can't print stuff, and we're witnessing that. So for us, it's pretty clear as to where we need to be long and where we need to be short. But those, I think, are the main risks. sitting in front of us now, outside of the sort of existential risks of world war or something of that description.
I think you highlighted a lot of different cross currents there, because rationally, a lot of people would think that if the dollar was strong, then there wouldn't be this type of stagflation and inflation. But we've had just the culmination of decades in many different countries of bad energy policy, and it's led up to this point. And then you exacerbate it with what the pandemic and all the rules, regulations that happened with shutting down supply chain problems. And now here we are with a global food and energy crisis. And I spoke to you, I think, in March or April last. So it's been almost 4 or 5 months since I last spoke to you. Has the food and energy crisis, has anything actually improved?
No, it's gotten worse. It's gotten worse, unfortunately. And again, so there's a couple of components to this entire setup. One is I think we discussed this before, Jason, which is we've come out of the period of intensive globalization. And intensive globalization has meant that we've consolidated and centralized more and more industries. The just-in-time inventory system, the way to be productive has been to centralize and minimize basically any of your OPEX where possible. If you could hold inventory, if you were holding inventory on whatever, just some widgets for 2 weeks, and you could bring it down to 1 week, well, that would allow you maybe less storage space, and that might be shaving 2-3 points off of your OPEX. And so that was that was the situation which we had, not just for a decade or two, but really in fits and starts, but pretty much post Bretton Woods. That whole system is now under attack, and the way to think about things, I think, is to look at them from a perspective of resiliency and dynamism. So like if you and I were running a business and we wanted to be dynamic, a classic example would be Silicon Valley over the last couple of decades. We would have been slaughtered if we attempted to be resilient, i.e. to get to profitability as quickly as possible. And the reason that we would have been slaughtered was because our competitors were all going about acquiring user bases. And if they needed to do so at a operating loss, they'd do so because you were rewarded for growth, not for profitability. And that's reached an extreme. So what you have in that situation is you have the extreme dynamism, but you have almost no resilience. And that's, if we're talking about Silicon Valley, that's probably evident to most people listening to this. On the other hand, if you think about our food systems, centralization has also taken over in that. So monoculture, for example, food production, just-in-time supply chains. You don't produce your own fertilizer, import this, import that, and really just optimize that one thing that you are focused on. And that's how you got better margin expansion. And scale of economies works. So we've had this period of increasing centralization, and that's left the world very, very vulnerable to what we're experiencing now, which is a breakdown of that entire structure. And so in that environment, what is needed is resilience. So you can actually look at, if we're talking about food, I've highlighted this before. Just take a random country that I'll mention, and there are many others, but Serbia, for example, has roughly 80% of its farms are family-run farms. And they are not monoculture. So it's a farm. They've got maybe some hens, and they've got some goats, and they're growing some carrots and whatever. Okay. Very, very different to a large operation where they're just growing carrots. What they lack is dynamism. However, they're very sustainable, very resilient. So those are kind of two, classic examples of a system. One presenting fairly extreme resilience, the other presenting fairly extreme dynamism. And, we go through these long-term cycles. We're in this long-term cycle of going from a globalization to deglobalization. And in that phase, what is important is to look for resilience, because the resilience is where the profitability basically lies. And we move very quickly into a Maslow's hierarchy of needs type of scenario. And in that world, what is required, what is needed, is trumps what is wanted. So your Netflix subscription is not wanted. Well, it might be wanted, but it's certainly not needed when you're trying to figure out whether you need to pay your electricity bill or whether you're going to put food on your table. And so what is critical, what is needed, becomes asymmetric. That would be the case if it were not for the fact that we have a war on energy and a war on fossil fuels, which we do have. So it actually makes the situation even more extreme.
Yeah, the comments from the Saudi oil minister this week have been pretty nuts. I mean, he straight up criticized the U.S. oil futures market. I mean, he was saying stuff that the gold and silver community have been saying for years with gold and silver futures contracts. He was talking about paper price manipulation with oil futures contracts. Huh.
What was his statement? You're gonna hurt, something about hurt.
Well, he was talking about how the physical market is a lot tighter, and maybe OPEC and the Saudis need to start cutting supply if there's going to be all these games with the paper market.
Well, what he was, I can't remember. I'd have to look up the quote, but he was like, if you guys are basically going to try and dick around with the paper market, we own the physical, and we're going to burn you. Like, you're going to hurt. It was classic.
Well, wasn't it like 10 days ago? I'm not sure if it's still the case, but wasn't Iranian crude oil? It was selling at a $10 a barrel premium to the futures contract. So that's pretty. I don't think I've ever seen that in the oil market before.
It's a fascinating time, Jason. I mean, one of the other things, just tying into the back of that, one of the comments that I just made was that energy is the economy and energy is currency. Well, the other thing that's a currency, of course, is precious metals. And so now we have Russia setting up the Moscow exchange, which because they don't want to be trading on the LBMA. After that fiasco that they had with nickel trades, I don't blame them. And actually nobody else would. At the time, I remember saying, you know what, this is the end. This is the end of these idiots, because what they've just destroyed is trust in the system. And it didn't matter who you were. You had Cliff Asness, who is a big boy in that space, and he started, suing them and everything else, and he still, there's still no resolution to that. And rest assured, if a guy like Cliff can't have sufficient influence in that market, then people like you and I are really toast. So now you've got an exchange which can't be trusted because they just cancelled trades, post trade, which, you can freeze markets and do things of that nature, and which they have done in the past, but you can't, like, after the fact, go and cancel people's trades. Like, that's, you can't do that. And so at the time, I remember looking at that going, you know what, this thing's toast. This is done. I don't know what replaces it, but there will be alternatives built, because the sheer nature of human transactions requires us to have something in which we can place a certain level of trust in. And that has just been decimated here. And so now we find the Russians coming out with a Moscow exchange, which they want to, and have stated very clearly that they see this as an underpinning to the a currency utilized by the BRICS and based on commodities. So, it's not just oil and energy. It's very much coming down to the point of who actually has the stuff. And I wrote a report, a special report for subscribers, which we finished a couple of weeks ago. And we're talking about the financialized world, the physical world, and these are really largely on a geographical basis the difference between the West and the East. Unfortunately, and I say unfortunately because I'm a white guy, sitting here looking at the future as it's like falling in front of our eyes, and realized this some time ago that the West is got this very indebted financialized system, which they're attempting to hold together with now coercion, and they don't have the stuff anymore. So we're kind of going through this transition where, again, but look, for investors at this point in time, it's a matter of just understanding there are critical needs that we have, which is pretty much Maslow's hierarchy of needs. And those countries and those regions and interested parties, if you will, that hold the gold, are historically going to win. That's the, it's not me trying to, people might come out and go, oh, you're a Putin fan or whatever. It's like, no, I'm not a fan of any politicians, but I am a realist, and as a fiduciary of client capital, my job is to make them money and to protect their capital. And so you can't myopically look at this and go, oh, well, it's us and them. It's not that simple.
Yeah, I think India, to add to your points there, I think India is also setting up a larger physical bullion exchange. So they announced that too. So they don't trust the LBMA. They don't trust the COMEX. Who knows if India had an enormous amount of physical gold supposedly stored at the Bank of England and the LBMA, and that might be gone. So they need a larger volume. They also have a counterfeit problem with imported gold. So they're going to try to set up a much larger exchange, similar to, I guess, Russia's planning it. And then you have the Shanghai Gold Exchange, and the premiums for physical gold. I don't know if you saw this. The wholesale premiums for the Shanghai Gold Exchange are up to, I think, $14 an ounce. So that's near a record high too, as well.
Huh, I didn't know that. Wow.
Yeah. And Swiss gold exports into China just hit a 5.5-year high. So we're having like the dip in the paper gold price here in the US with the dollar index rising, these global macro hedge funds that as soon as the dollar index goes up, paper gold futures are sold or shorted. The East is buying the gold.
Well, so here's a couple of interesting anecdotes. I've been in contact with a bunch of bullion dealers over in the UAE. Brinks in particular, the guy there told me something interesting, which is that the greatest amount of their inflow, they're receiving inflows, like huge inflows of both capital and gold, physical gold, that's getting moved from their other locations. Because remember, Brinks are all over the place. Like, I think they are the biggest or one of the biggest in that space. And guess where their largest amount of gold being transferred from is coming from?
The US.
Switzerland.
Oh.
See, Switzerland has always been it's the safe haven, right? That's where everybody went to put their money. But now they turned around and they no longer are neutral. So imagine you're a Russian and you've got your gold stored in Switzerland. You're like, maybe not. I mean, Singapore's
built a ton of vault space too. I think they're increasing their silver vault space by 10 or 20x in the next couple of years too.
Yeah, but you know what? The interesting thing has been Dubai. The Middle East. See, the Middle East it's the glass house that Dubai is the glass house that nobody wants to throw a stone at. Why? Because the Iranians have got their money in there. The Israelis have got their money in there. The Chinese have got their money in there. The Russians have got their money in there. Everybody's got their money in there. Nobody wants to upset that particular apple cart. And so it's the relative safe haven in this crazy world that we find ourselves in now. And when Switzerland turned around and said, no, we're no longer being neutral, they just like, it wasn't about politics. I mean, it was about politics, but I can't imagine that they'd be that stupid, because their entire monetary history has been reliant on that neutrality. And it's like, you don't just get to say that and then not massively affect your entire monetary system. It's like, I don't know what they were thinking, but there it is.
Well, like 6 or 7 years ago, the Swiss banks, they started handing over customer account information, right? So it started crumbling then. So you had the Europeg. So you had the Europeg experiment for about 3 years that failed, because then the Swiss National Bank became a hedge fund. They created around $300 billion out of thin air, and then started buying U.S. technology stocks with the currency created out of thin air with the Europeg. And then they handed over the customer account list to the U.S. government. I think that was 6 or 7 years ago, something like that.
Yeah. So it's been a long time coming, Jason, and now we're just sort of seeing it accelerating. And that's the shift of capital from the west to the east. And it's, it's weird in some sense, because I've been monitoring this for years, as probably you have. And, I find myself being, like I said, the white guy, a round eye, sitting here going, you know what? I gotta go with the flow. I gotta go where relative safety and security is. And it's not in the West.
Yeah, you can't invest on hope or an ideal. You have to look at reality.
Mm-hmm. You do. And the interesting thing, when Russia came out saying that they're going to launch the Moscow exchange, their statement was that the LBMA manipulates the precious metals market and keeps prices artificially low. And in particular, this is an unfair practice because it negatively affects precious metals exporters, namely Russia, amongst others. And so, people have been saying this for years, but this was them coming out saying it, which I think is fairly significant. And it's that loss of trust, loss of faith. And they're like, nah, we're done. We're not playing your game anymore.
I want to ask you about deflation now. So the narrative among a lot of these global macro people, the macro tourists, the people who aren't looking long-term, short-term, is that inflation is over, the consumer price index is topped, the dollar index is rising, commodity futures prices will keep crashing indefinitely, the commodities bull market that lasted about 2 years or so is over. Do you think that they're correct, or do you think that this is just a short-term problem here, and the supply side problems, higher costs for commodities, it's only going to get worse in the years to come?
You see, the generals always fight the last war. And so I see these fund managers and pundits and whatnot, and they're often looking back and going, oh, well, 2008, or so they tend to look back, especially into the experiences of their own lifetime. Now, I think that's partly where the mistake lies. If you go back and you look over a 100-year history, you can get a much clearer picture as to different cycles. My belief, or our belief at the firm, is that this will be an inflationary depression, or stagflationary in particular. That's not something that we've experienced for within our lifetimes. And it's true of even if you're a 60-year-old. So I understand people sort of looking and going, oh, well, this is what 08 was like, this is what 2016 was like, and this is what the Fed did, and this is what happened, and looking at those dynamics. If we just stick purely with the energy market, but it's true of elsewhere as well. But if we just focus on that, there is ample reason to say, oh, well, we're going to have deflation, because in a recession you have a fall off in demand, right? Now, and we will have, and we are getting a fall off in demand, but not everything is made equal. So your fall off in demand can easily, like I mentioned before, impact your Netflix subscription, but it's not going to impact your, to the same extent, it's not going to impact your electricity bill, right? Or your desire to pay the electricity bill and to keep the heat on if you're in the winter and you're up north. So the other thing to consider is this: if you have a fall in demand, but your supply is falling faster, you have a rise in price. It's that simple. We are getting there's been insufficient capital investment into the energy space such that supply is not coming on stream. And this is what the Saudis were saying this like 2 years ago and then a year ago, talking about spare capacity. And, they've become increasingly, what's the word? Obvious in their, you know how a lot of these bloody pointy shoes will sort of talk around the bush a little bit, right? They won't be very explicit. Just like Jay Powell will often talk in the same way. It's like they're not deadly explicit. Well, over the course of the last few months, they're getting more explicit, to the extent where they're literally just going, look, we don't have, there's not spare capacity. And at the same time now, even while you've got the Saudis and the Russians that are not destroying their energy infrastructure or capacity, in fact, they're investing in it, the balance out there in much of the Western world has been to just destroy it. The cancellation of Keystone, the shuttering of nuclear power plants in Germany, coal plants, you name it, banning of shale in the UK, banning of shale in the Netherlands, it's gone and on and on. And so now those countries are all structurally short energy. And there's just not enough is the answer.
Well, the other thing I think the deflationistas are missing, and in the short term, they may continue to be right. Their commodities prices may go a little bit lower. The dollar may rise a little bit higher. Who knows what other games the Treasury and the Fed can play. But Cuppy has brought this up. And we see this with the quarterly earnings for all the commodities producers. There's a new normal for much higher cost structure. I mean, the cost for some of these oil drilling
100%.
companies is their costs are up 15% year over year for drilling new oil and natural gas wells. And I don't see those costs coming down significantly anytime soon.
The only way that the costs can come down is if you increase supply, right? I mean, if you just took something as simple as air travel, I've just been booking a bunch of flights and it's like, Jesus Christ, the prices are up significantly, and so, but how do you bring down the cost of that? Well, a huge component within it is jet fuel. So how do you bring down the price of that? Well, you've got to actually go out there and you've got to find some more fuel and you've got to bring it out of the ground. And that's not happening. So long as that is not happening, then we're going to continue to see inflation in multiple sectors. Now, that can be taking place at the same time that people's incomes are being impacted significantly, losing jobs, corporate bankruptcies, and things of that nature can and will impact demand 100%.
Sounds like stagflation, yeah.
So it's a very difficult and intricate period of time to be investing because there are a lot of moving parts, and you need to analyze each of them while at the same time understanding them in the context of the macro theme, right? So you can't just I've seen people coming out looking at Apple, for example, going, oh, it's a buy now, and it's like, I'm like, for starters, if you just go and you look over a historical time frame, it's like it's not cheap, right? So, but if you looked at it maybe the last 12 months, you go, oh yeah, it's like relatively cheap. But that's just looking at one tiny element. Then if you kind of scale back and go to a 40,000 foot view, and you go, okay, global depression, who's buying iPhones? Who's upgrading their iPhone every year? Who's buying more MacBook Pros? The answer is that
that's exactly what I'm thinking. Yeah.
It's less than it was. And then when you look at, so that's going to impact earnings, and then you look at the valuations and you're like, okay, this doesn't make any sense. I'm not suggesting necessarily to short it, but it's like you just don't step in front of that steamroller. So in that situation, one can easily say, we've got deflation. We can have deflation in quote unquote growth assets, right? And these aren't necessarily, the Ponzi stuff that we've looked at. These are solid, good run companies, but they're just not cheap. And they're going to get impacted by a demand fall off, because people don't need a fucking iPad when they're hungry. I mean, that's just true. So
wall costs are going up too.
The costs, yeah, you just mentioned it. I mean, the cost of the inputs for these things are going up. So, they're in for we're all in for a very difficult time frame where it's their classic stagflation, shitty economy, rising costs of everything. And so what becomes, and in that environment, it's difficult to stay ahead as an investor. And so what I would suspect people need to be very focused on is the supply and demand differentials in particular sectors, taking into context the macro sort of play, while simultaneously looking at the geographical plays that are taking place. Like we just mentioned, India and China and Russia, and this new alignment, if you will. It's not actually that new. It's the BRICS or the SEO, just writ large, but it's being accelerated now. And the other, there's something else, which, like on FinTwitter now, I guess the vast majority of people are Americans, and it tends to be quite US-centric. But for what's it, the first time I think in about 300 years now, emerging markets actually make up the majority of global GDP. And China is the world's biggest trading partner. It's like, to ignore this stuff seems just really nuts to me. So that's true anyway. And then when you look at these countries which are being forced to make alliances with one another, by taking out Russia with sanctions and taking out the energy and food components there, because that's what you do, they've forced other countries to make a decision. And it's very, very clear that many of these countries are not part of the quote-unquote global alliance against Russia. There's over 150 countries that are not sanctioning Russia. In fact, there are only a few in the world that are. And it's largely Western Europe, Canada, and the US, and the Five Eyes. So, it's those are things I think that people need to be paying some attention to. The old world, that the structure, the old geopolitical structure of the world, which is really kind of been under the MacIntosh doctrine, which was to ensure that the Eurasian landmass stays under the control of US hegemony. That's falling apart, because the way that they managed to actually retain that was to ensure that the various components within that landmass never got together. That's why they always kept fighting and paying for both sides of every war. It was better to have them all at each other's necks, and to never actually gain real economic or political influence, and certainly not to join one another. Well, guess what's happening? They're all getting pushed together now. India, Russia, Iran, they're all getting pushed together and dealing with one another because they have to. And that's really, really important for people to understand, because that doctrine and that ability to hold that together is now being tested. Let's just hope it doesn't turn into a World War III, but That's what's taking place. And the other thing, of course, is that if you take the vast amount of energy in the world, well, guess who's got it? It's like these guys. So
yeah, that's an important point you brought up there. So I've been talking about this for a while. So almost all the mining, all the oil and gas, it's all occurring in emerging markets or countries like OPEC and Russia. So a lot of the Western world, whether the United States still has a good amount of oil and natural gas, not in every state, but a good amount of the states are still pro oil and natural gas drilling. But for a lot of the developed countries, they're anti-mining, anti-oil and natural gas. And now you have all these problems with exporting. All these countries are banning fertilizer exports. Or now with natural gas, I mean, you just tweeted this out recently. You have natural gas orders, LNG orders that are being canceled for emerging market countries and shipped over to Germany and Europe.
Mm-hmm. Yep.
So if you don't have any of your own domestic supply, or you don't have reliable trading partners, I mean, your orders can get canceled, and then you don't have any heat for the winter. It's just
and it's food shortages, and it's literally people starving. So no, there's huge issues coming. I mean, I just wrote about Senegal, right, who just done a deal with Russia basically for grain. So, the mechanism that the West has been utilizing for decades now has been using the IMF and the World Bank as proxies of the political arm. And they would go in there and indebt countries, and then they'd make sure that they could extract the resources. That was just how it worked. And what there is now is a contest for that, and for what I call the global South. And so on the one hand, you could have the IMF, for example, coming to Senegal going, "Oh, we'll give you some money. You need to do X, Y, Z in order to get that money," right? Which is what they did with COVID. It was, yeah, you take the money, but you need to follow these measures. You need to lock down, and you need to do this, and you need to do that. And because politicians are corrupt, they did it, and they took the money. The offer now on the table increasingly is this, from the Sino-Russian influential side of things. It is, yeah, we'll give you food and energy, right? And then what does the IMF got?
China has done debt diplomacy too. I mean, they've over-indebted a lot of these countries in Africa and South America for access to ports and mines and oil and natural gas. I mean, they got most of the oil from Venezuela. They have rights to it, and then oil from Ecuador. So, I mean, China has copied the economic hitman debt diplomacy model from European colonialism in the US.
100%. Yep. And so when you look at Chinese loans into Africa in particular, they swamp anyone else. They they own much of that landmass. And so now, for example, if the IMF come along and they go, "Hey, pick a country, Ghana, we want you to do X, Y, Z." maybe it's around climate initiatives, but at the same time, the energy in that country is basically owned by Chinese banks. When that energy's got to move, do you think that the Chinese are going to stand by and let them cancel it based on something that Greta Thunberg wants? I don't think so.
Absolutely not.
So we're headed for a clash of some description in that space, but the groundwork has already been laid. As you correctly mentioned, it's debt diplomacy work from the Chinese, and then what the Russians are using as a weapon, or shall we say as a carrot, is food and energy. And so, like I said, when you say, okay, what is it that the West has to offer? It's paper script. It's, yeah, we'll give you loans, but typically the loans are contingent on not, for example, trading with Russia. So if you just take a very simplistic example of, country X, which gets offered on the one hand grain from Russia, and then on the other hand, it gets offered paper script from the IMF. But in order to feed the populace, it needs to take the paper script and convert it into grain. But you're not allowed to actually convert it into the grain that's sold by Russia. What are you going to do? These are all questions that are going to have to that will get answered over the course of the decade.
So less capitalism, less free markets, less global trade, and as you said earlier in the interview, deglobalization, because you have these governments saying you can't trade, well, the U.S. government really, and then their stooges, what in the European Union, in the UK and the European Union, they're stooges or vassal states, just repeating what the U.S. says.
Yeah, well, like, I mean, Europe is just a vassal state of the US at the moment. They're basically completely under the US control, certainly with respect to the energy side of things. They've cannibalized their own domestic production side of things, and now they're going to import energy from the US. So that works out really well for the US, but it doesn't work out well for the Europeans. They're the biggest loser in this by a long shot.
Oh,
and
yeah,
what they're doing now is they're actually just buying Russian energy, but they're buying it from the Indians, the Saudis, and the Chinese. What are they doing? Well, the Indians are buying it from the Russians, turning it around and selling it at a premium to the Europeans. The Saudis are bringing it in, using it for domestic purposes, then selling their own oil onto the Europeans, saying it's fine, it's our oil, it's not Russian, so it's not tainted, it's not bad, but it's just a swap. And then the Chinese are refining it and selling them the premium product to the Europeans. Everybody's winning except for the Europeans.
Well, the Europeans are also getting LNG shipments that the emerging markets. So the emerging markets are getting screwed over in this too, because they have low commodity prices. You have protests in the streets in many different emerging market countries. They want higher wages because inflation is rampant. So there's just potential governments destabilizing with really bad stagflation. That's even worse in emerging markets. And now with low commodities prices, a lot of those potential jobs for mining, oil, natural gas, agriculture, those jobs, they could lose their jobs too.
Yep.
And then there's no natural gas because Europe got the LNG shipments. They were redirected because Europe will pay more instead of emerging market countries because they don't have the dollars.
Yeah, exactly. So we've got a dollar shortage problem there, which is another reason why you don't want to be short dollars. Ultimately, I think the dollar blows up and it goes away, or it loses its reserve status. But what I think people are missing is that the process to getting there is more likely a raging dollar bull market than it is it wilting away like a lettuce in the sun.
And we can also have a bunch of emerging markets collapse in the meantime. But then in the short term, that might cause like deflationary pressure, maybe lower commodity prices. But then like all this supply is going to come offline for a lot of these commodities. And then 2-3 years from now, we're going to be talking again about another commodities bull market with even worse supply side problems, even if demand is destroyed.
Yeah. I mean, I think, Jason, what it lands up, it's hard to know, and you don't want to look out too far because there are a lot of dynamics and you've got to keep your eye on the ball. But there is a potential here that we have a very, very extended bull market in commodities over and above that which you would ordinarily get through a typical commodity bull cycle, which we're only in the first innings of, like on a traditional basis.
Yeah, so, I mean, other than U.S. natural gas supply, Chris, I mean, there's not a lot of new supply online for any commodity.
No, I mean, if you just look at copper, 30% of copper supply comes out of Peru. Guess what's happened in Peru's, sorry, not Peru, Chile. Guess what's happened in Chile since the socialists just took over?
Well, they also
additional granting of leases. Like there's basically no extra supply whatsoever.
They also
that's
put a big
30% of global copper supply. It's
well, when copper almost hit $5 about 12 months ago, didn't you also see that they put a new punitive copper, sliding scale copper royalty? So, I mean, if you're a copper miner investing in Chile, you're going to say, wait a second, if you're going to put a large royalty tax, I'm not going to build a new mine.
Exactly. So your capex collapses, and guess what? Peru's doing the same thing, by the way. But at the moment, like everybody's looking and going, copper. It's Dr. Copper, and the economy going into a recession. You can't buy copper. I'm like, no. Nobody's actually looking at the supply demand side of this thing. And then you got all these fuckwits that want to run cars on electric, unicorn farts and electricity and everything else. And that's massive amount of copper. Where are they going to get the copper from?
I think those same people think that electricity just comes out of the outlet.
Yep. You got it, brother.
Well, Chris, I really enjoyed our discussion today. If my listeners want to take a look at your website, your research, your newsletter, how do they do so?
Jump onto capitalistexploits.at. That's A for Apple, T for tomato. That's where our newsletter publication is. And for high net worth individuals, you can go to glenorchycapital.net. That's our asset management firm.
Excellent. Well, thank you so much for your time. And I'll definitely have you back on in a couple months, because it just seems to me, Chris, with all these policy changes, rules, regulations, interventions by governments and central banks, the cycles that we have now are just shortened. So it seems we're going to have like 2 or 3 year cycles with a lot more volatility in asset prices going forward.
Yeah, and I mean that's you just nailed it. Volatility. I think that's the one. Like, when we started this conversation, you said what are some of the risks. One of the biggest risks that I see, at least from a standpoint of an average investor, is getting whipsawed and not understanding the big picture, because we're going to have real volatility and significant pullbacks in a broad commodity bull market. And remember, you can get 30, 40, 50% pullbacks. That's pretty brutal, but we're going to get them. Like, you can't sit there and there's no way to not get them. You know what I mean? But I think that one of the greatest risks is really not understanding what you've bought and why you bought it. Because you might get lucky and you buy something in, just say, I don't know, uranium, and you do really well, and then you get a 50% pullback, and you go, oh, that's it, I'm finished, it's over, and you sell into that. And not, you really need to do your research and understand what the big picture is, and understand those very critical supply and demand dynamics. And then you can factor in what the Fed's doing and what liquidity is doing and all these other things, which will impact it, but they're not going to impact the ultimate sort of end game, if you will, of that. It's like I just there was something the other day I saw on the Idiot Tube, and it was Kramer coming out, and he's like, inflation's down by a couple of points, and Jay Powell's doing the best thing ever. He's fixing it. And then when I looked at what they were analyzing, what was down, it was apparel, air travel, and I'm like, if you don't even need to be an economist or a finance guy to look at this, and you go, okay, by them mucking around with interest rates, tell me, did they create more flights such that air travel became cheaper? Like, did they create more apparel out of Bangladesh? Like, it's just so.
Well, Sri Lanka is collapsing, so I don't think they're exporting the apparel that they used to either.
No, exactly, and that's the thing. So you could say, well, that's deflation, and there's a demand collapse. Yes, there is, but there's like supply collapses too, right? The Sri Lankans, just because of the World Economic Forum's stupid policies, produced like 20% less rice during that experiment, and it's not come back either. So that's, and then across their food channel, it's about 45% in terms of all the commodities. So that's like, that is a significant supply destruction at the same time. So people need to understand, it's not just like, the old recession that we had before, we didn't have all these supply chain disruptions. We didn't have all of this other stuff going on. It was more isolated. It was easier to just make the judgment call and go, oh, fine, we're going to have a bit of a demand collapse, and people won't be maybe buying as many 5-star Michelin class restaurant dinners. Fine, whatever. But that's not. There's a lot of other dynamics in play at the moment that really need to be considered.
Yeah, especially for food and energy. And these supply issues, they will take years, and there's very little signs that there's any new supply coming online for most of the major commodities. You brought up uranium. I mean, uranium, fertilizer, base metals, there's a lack of investment. Even with high commodity prices for 2 years, there was very little investment into bringing new mines online. The plans to start bringing new mines online were just being made. The construction for a lot of these potential new mines had not even started when commodity prices crashed. So the mining companies are going to be very hesitant now to bring new mines online.
Very hesitant. And then the other thing that you got to consider is there needs to be a level of certainty, because these are very capital intensive types of businesses, right?
Mm-hmm.
And your payoff doesn't happen within a year. It's often over like a 5 to 10 year time frame. Let's take it as a 10-year time frame. Are you going to go and sink hundreds of millions or billions of dollars into a project where you're not sure within 10 years whether there's going to be a market for your product, right? Because these woke retards are telling us that there's not going to be fossil fuels by 2030. We're not going to have ICE vehicles on the road. It's going to be all electric, right? So then when you look at that and you go, okay, well, do I go and start drilling for oil? Like, and are they going to tax me, or are there going to be carbon taxes on this industry when they're telling me that this industry is not going to exist by 2030? Like, you don't have the certainty to go out there and spend billions of dollars and sink it into the ground. So you don't.
Exactly. And that's why these companies are increasing dividends, doing share buybacks and mergers and acquisitions. They're not investing billions of dollars into a risky project for where supply comes online years from now.
Totally. I mean, because like Africa Oil, which is one of the companies in our portfolio, just did a 20 million share buyback because they're sitting there, they're printing money, very, very profitable. And you go, what are you going to do with it? Well, if your stock is undervalued, just buy it back, right? But
or M&A, M&A will be the next, mergers. If they're going to short the paper markets, go and buy the paper barrels of oil, the reserves at a discount then.
Totally. You take advantage of that. In fact, the more that they do that, the better it is for you, because that just gives you more time.
Yeah, and more cash flow.
I want these people to go and fuck around with the paper markets. Just keep doing that, because I just want to keep stacking.
Well, if you run the company right, why invest in a risky long-term project when you can go and buy another company with cash flow at a discount if they're going to manipulate the market?
Yep. You got it.
Well, Chris, I really enjoyed our discussion today. I think my listeners are going to get a lot out of this. Thank you so much for your time.
You're welcome, mate. Always good. Take care.